It's a paradox to some that the road to financial freedom goes through debt. Debt means leverage, and leverage, that means the ability to control enough properties over time for you to have financial freedom while your entire debt payment, mortgage principal, and interest and everything else is all outsourced to tenants. So therefore, I'd like to welcome in the president of the mortgage company where I get my own loans personally. They've helped more families realize their dreams of financial freedom than any other mortgage lender in the entire nation. And they lend specifically for investment property in almost every U.S. state. They've now funded over 45,000 properties. And the thing I like about them is they are real estate investors themselves. She is. I am. And what they do is they really get in there and they structure both your current and your subsequent loans for you, this kind of strategic planning over time. So I'd like to welcome back to GRE Ridge Lending Group President, Caeli Ridge.
Hi, Keith. Hello, everybody. Thank you for having me. You know how much I love being here with you and your listeners. It's my pleasure.
Financing is such an important part of real estate investing, Caeli. And, the landscape changes over time. Now, unlike 15 or 20 years ago, where we had all these risky loans, today, you could say the housing market, I think, is underwritten by more foundational loan types. Black Knight tells us that the average mortgage borrower FICO credit score back in 2010 was 699, and today it's 751. Homeowners have big equity positions today, record equity positions, in fact. So talk to us some more about real estate's stable foundation through these tight underwriting guidelines that persist.
It's absolutely true. I'll tell you that post 0809, the bar in which we've been forced to qualify really increased. It was almost going from fogging a mirror before 0809 to walking on water. I would say that that's even low, the 751 average for our clients. We find that it's probably 760 and above. So absolutely. Then you've got, the other qualifications of DTI and asset requirements and things. All of those things have kind of stepped up. So I think that for those reasons, certainly we do have a more stable platform in which lending is being secured by. Adjustable rate mortgages, finally, thank you, are coming back into the mainstream. I've always been a big fan of ARMs. We've talked about this. Interest only, likewise. But I'm getting some people that they aren't as informed as maybe they should be. So they're hearing these buzzwords like ARM or interest only, and they're kind of labeling them with those bad boy loans. That was the root of some of 0809. And I want to dispel some of that because I think it's really important to put a check on what a bad boy loan is. An adjustable rate mortgage, everybody, is not a bad boy loan. In fact, it's probably my preference when the market is stable and under normal conditions. We've been on what's called an inverted yield, right? Maybe you've heard me talk about this before too, where the 30-year fixed mortgage rate is lower than an adjustable rate mortgage. So over the last 10 plus years, there's been no incentive to consider the ARM. Why would you take an adjustable that's a higher rate than a fixed? You wouldn't do that. Well, as the feds have been rising rates and we've been seeing the rates go up aggressively, maybe even violently in some cases, the ARMs are starting to become more mainstream. So I'm super excited about that. I can talk more about ARMs too. The bad boy loans, though, are the loans that they were giving people, and we didn't subscribe to any of this. You were giving an investor 100% leverage, 100% LTV, zero down payment, stated income, no assets. They had NAGAM loans. They were giving people money that 105% LTVs. So those would be the bad boy loans. What we're talking about now and here under this more stable foundation, because the qualifications have been higher, that bar has been risen. By no means would I even begin to call that or an interest only a bad boy loan.
Things like interest only loans and ARMs, adjustable rate mortgages, they got a bad name in the mortgage meltdown about 15 years ago because oftentimes that's the only way that one could qualify for a property. Now, Caeli, you bring up ARMs, adjustable rate mortgages. I was just looking about a week ago and I noticed that the 5-year ARM mortgage interest rate was about 1.5% lower than the 30-year fixed rate mortgage that most people are used to. And a lot of people don't understand a 5-year ARM, that actually means that your rate is fixed for the first 5 years before it begins to adjust.
Based on the data that you're looking at is raw data. Just so everybody understands, it doesn't mean that you're going to go out and secure a loan that 30-year fixed would be 6% and the 5-year ARM is at 4.5% necessarily. The variables or the characteristics of the loan transaction itself will dictate what that spread is. So if you're comparing, just as a quick example, an owner-occupied purchase with 25% down to a non-owner occupied fourplex cash out, that spread isn't going to be the same. But yeah, we're seeing the margin grow between the 30-year fixed and the ARMs. They're coming back down. I would say on average, we want to see at least a half a point improvement with the ARM versus the fixed, ideally a point, maybe even a point plus, but we're on the right track. We're moving in that direction.
And a lot of people with this record equity that I touched on earlier have that static equity that they may want to access because, as I'm fond of saying, the return from home equity is always zero. However, if you do borrow against that property with a cash out refinance, of course, you do have to pay an interest rate, and then it's your job to go meet or beat or exceed that interest rate that you're paying, borrowing the money out of your property in order to create that arbitrage. So why don't you talk to us more about what one can do today with this glut of equity that Americans have?
Keith, I'm glad you brought that up. I've been having the conversation quite a bit lately, obviously, as rates go up and people have this equity and they want to get at it, they want to harvest their equity. But more often than not, when we have the discussion, they're learning that the rate that they're going to refinance into is going to be higher than the rate that they have now. That's probably a pretty typical scenario. I'm really encouraging people to take the psychology out of it, right? They get fixated on that number and they're not looking at it holistically. And it's very, very important that they do the math, okay? And by the math, first of all, like you just said, run the numbers. What's the new payment with the extra cash, the equity that you're pulling out at the higher rate probably? What is the different monthly payment between the two? Is it still cash flowing? Are the rents still covering it? And then you need to take that cash and figure out what the return monthly is going to be. Is it going to cover what you're losing in cash flow over here? Is it going to exceed that? And then you still need to take it a couple of steps further. Make sure you're accounting for the annual appreciation of rents, not necessarily the house value right now, but of rents. And then you've got that tax benefit too, gang. And this is a little bit harder to determine. You're going to have to dig in a little bit more to calculate. But the higher the interest rate, what happens to the mortgage interest that you're able to deduct on your Schedule E? It's going to be higher, right? Yeah. So it won't be dollar for dollar, but just please make sure that you're doing the math and don't make the assumption that because rates are higher, it's not the time to pull your cash out. That is not a true investor mentality. Inform yourselves and do the math.
Now, can an investor have the best of both worlds? Because right now, a lot of both homeowners and investors have locked in those record low mortgage rates from, say, a year ago or more, where they might have a 3% or less mortgage interest rate on the primary residence or a 4% or less mortgage interest rate on their rental properties. Can they keep that loan in place? Is that often the best thing to do? And then take on a second mortgage with the cash out refinance?
I think, again, let's do the math. I'm not trying to imply that the refinance is a foregone conclusion, right? Maybe the rate that you have now, it doesn't make sense to do that full cash out refinance. Maybe we do look at a second lien. And yes, I like a HELOC, a second lien HELOC by all means. The other thing to look at, maybe a first lien HELOC all in one, even if the interest rate that you secured a year or whatever ago was very, very low. Maybe we consider that. Let's do the math. The second lien HELOC on an investment property is going to be the harder of all of those scenarios to obtain. They're not prevalent out there. I can share with, if you'd like, a few of the banks I know are doing them for non-owner occupied. We unfortunately don't do any second liens,
sure,
but I know that PenFed is doing second liens for non-owner occupied. The CLTV, combined loan to value, right? It's not the LTV, but the combined loan to value, CLTV, is going to be on the lower end. I want to say maybe 65%. And I remember hearing somebody tell me that you can't have more than 6 finance properties. So, well, they are doing it. The confines in which you can get approved are going to be a little bit tighter. Bank of the West is another one. You're going to have to start dialing for dollars, guys. If you want a second lien, there are probably a few others out there, but you got to go digging for them.
Not driving for dollars, but dialing for dollars. In this case, we're talking with Caeli Ridge. He's the president of Ridge Lending Group. You can get pre-approved and learn more about them at ridgelendinggroup.com. And Caeli, I think most any reasonable person knows that the Fed was not going to keep interest rates at 0% forever. That was really an emergency measure. So as the federal funds rate has come up, and really all interest rates have come up with it. Talk to us some more about that and the interest rate landscape today.
Inflation, guys, the first thing they're going to look at to start stamping out inflation is raising the Fed fund rate. I want to clarify for you, the Fed fund rate, for anybody that is not aware of this, is not our long-term mortgage rate. The Fed fund rate is the daily trading rate between banks. Okay, so they're two totally different things. And while they're connected, they're not the same. But guys, remember, it's not about the rate. You're appreciating your rents. please make sure that you're looking at it from that holistic perspective. And then the other thing, Keith, you and I have talked about this several times, that psychology of rate, the difference between a half a point in rate based on your loan size could be completely inconsequential. So again, I sound like a broken record. Do the math, please.
Yeah, 100%. Because interest rates, that makes the headline. But talk to us about some of those indicators that are really important too. And a lot of them are things that people overlook because they're so fixated on the interest rate.
Well, cash flow, obviously, you want to be looking to see how the property is cash flowing at this rate, or maybe we're looking at an ARM now, maybe we're looking at an interest only. You're looking at your whole property appreciation, right? And what markets you're going to be in, diversifying your properties from a market perspective, property type perspective. I touched on a second ago, the short and the long term, keeping your portfolio diverse enough so that you can weather some of the changes that we're going to see over the coming months and years. We probably have 9, 12, 18 months, maybe 24 months in that range. I'm being pretty vague here because I'm not going to commit to what could happen along the way, but rates will come back down. That's what they do. They're not going to just go up and stay up. They're going to come back down. So just be prepared for this next wave, which actually takes me to another thought that I've been talking a lot about, the equity and harvesting what you have access to in your capital. If you just have a bunch of cash in the bank, okay, fine. I think Keith and I agree that leaving untapped equity there in its place and untouched is probably not sound. But whatever the case is, get at your cash, get at your equity, be ready, because I promise you the seller's market that we've lived in for the last couple of years is going to turn. I can already start feeling it. You're going to be able to negotiate price a little bit more, negotiate seller paid closing costs a little bit more. So I would say that in that regard, be ready, because it's here, it's happening. So get your ducks in a row. So
many markets are still sellers markets with multiple offers amidst a dearth of inventory. But yeah, it's not as hot as it was, as a housing market hopefully reverts more toward normalcy, and people could actually do normal things like not have to compete with all cash offers, or not feel bad about making some inspection finding requests and repairs as we hopefully revert to a normal market. So Caeli, what does market normalcy mean to you from the mortgage market perspective with where we are and where we're going? Some normalcy is going to be good for everybody. It needs to tamper. If we continue in the same trajectory that we've been, that's going to be a bubble and a huge crash, right? That's a problem. So I think that with the rates going up and all the other variables associated with this, we are going to see housing normalize more. That's good for everybody. Well, tell us about some of the other loan types that you offer in there, Caeli, beyond those ARMs and 30-year fixed rate mortgages and all-in-one loans. And what else do you offer investors? Yeah, I think this is a real strong point of Ridge Lending's value adds. We are not a one-size-fits-all. We don't just subscribe to the Fannie Freddies or adjustables, non-QM. So there's 5 prongs. We've got conventional, Fannie Freddie. We have non-QM products. This is outside of the Fannie Freddie guidelines, not just for investors, but for anybody. It's pretty diverse in and of itself. Bank statement products where if you can't show tax returns, that kind of thing. We have commercial products for residential property and commercial property. We have short-term bridge loans, fix and flip stuff. And our all-in-one is a very popular tool for investors, the right investors.
Hi everyone, Content Manager Matthew here. I'm sorry to interrupt, but I want to unpack this list of content for anyone out there who might just be getting into real estate investing who knew there were so many different types of loans. And Caeli is such an expert. She lives and breathes this stuff. She listed these all off like no big deal. 1. Qualified mortgages are backed by the government in the form of these companies Fannie Mae and Freddie Mac. The government protects lenders who make qualified mortgages, and it allows lenders to provide incredibly favorable rates and terms. Non-qualified mortgages are simply not backed by the government. It doesn't mean they're bad, and they're good for some people who are not able to meet those stringent requirements. If you're a foreign investor, you might not have any U.S. tax returns to show the lender during the underwriting process. And in this case, it's still possible to get a loan, but if all you can show is bank statements and you don't have tax returns, you won't qualify for Fannie Freddie loans. Commercial loans are for buying commercial buildings like office space or retail, and it might be confusing that it's commercial and residential, and that's just because it could be a pure apartment building too. That's residential commercial real estate. You could have mixed residential and commercial with apartments above, a storefront and a restaurant on the street level. The whole building is still commercial. 4, short-term speaks for itself. And 5, all-in-one loans are featured in our previous video with Caeli. It's a very interesting way of creating arbitrage. That video is linked to the card in the upper right. All right, that's all. Sorry for the interruption. Don't forget to hit like.
Talk to us about the QM versus not QM loans. Are we still going to be in this environment for the foreseeable future where a single person can get up to 10 loans at the best rates and terms, 20 married?
For right now, on a 30-year fix, yes, that's true. If we are looking at the adjustable rate mortgages, conventionally speaking, right now, for non-owner occupied, those are not going to be available. So in terms of cash flow, and if you are looking at an ARM or an interest-only product, Fannie Freddie is not going to give you the best cash flow today. It's going to be an outside non-QM type product.
All right. A lot of this depends on your strategy. For example, maybe you would want a 5-year or a 7-year ARM if you expect to have a short hold period. If you think you might be holding a property for a long time, then perhaps you would pay that 30-year fixed rate premium that you essentially pay in a higher interest rate for having that certainty over the long term.
Yes, absolutely. It's very individual.
Caeli, well, when someone contacts you in there, why don't you talk to us about the best way that a borrower can come prepared so that it's quicker for them and quicker for you to pre-approve a borrower?
So apply, right? We have an online application that you can go ahead and apply on. Make sure that you've got your typical documentation, your tax returns, your W-2s, your pay stubs, your ID, your bank statements, the vials of blood, right? Make
third grade report card. Yes, all those jokes about the third grade report card, right? You hear them all.
That's right. And so make sure you have those, usual suspects of documents available. We will collect them. Once we get you through that initial process, kind of a review, pre-qualification review process, then for those that are interested in really building strategy from an underwriting perspective, and then, my experience and knowledge base too, I have lots of one-on-one conversations with investors, and we start, looking under the hood, figure out what their goals are. I give them the education about guidelines and things of that nature, how to optimize their qualifications, and we continue to plant those seeds and make those roadmaps so that we've got a direction and a lane that we're going to be moving down as they continue to evolve as real estate investors.
Yes, the mortgage industry is replete with jokes about mortgage underwriting, in your pre-approval process, asking you for vials of blood and your 5th grade report card and everything else, because it is a pretty extensive process. You are going to be asked to submit quite a bit of documentation, but to relate that back to what we talked about earlier on here in the program, that's what helps underscore a strong housing market, because we're making sure that people can actually afford these properties. Well, Caeli, tell us about the best ways for one to get started with someone that specializes in income property loans like you.
You just want to get in touch with us, get an application underway, and we will start collecting those documents. There's a few ways you can reach us. You can reach us on our website, which also has the link to apply if you're ready to just go for it. ridgelendinggroup.com. info@ridgelendinggroup.com is an email address you can reach us, and then toll free at 855-74-RIDGE. 855-747-4343.
Caeli, these mortgage lending market updates are valuable. As always, thanks so much for coming back onto the show.
My pleasure, Keith. Thanks for having me.